That's okay. So I think when we met the first time, that was on Sunday, we actually talked about the financial management paper. And we started by talking about the definition of financial management, the functions of every manager, which the financial manager is also a manager. We decided to also look at the overall objective of every financial manager. Thereafter, we decided to look at other objectives of financial managers. We looked at financial planning. We talked a little bit about risks. We talked about agency theory. We talked about certain agency costs which tends out to come up. Thereafter, we decided to look at major decisions taken by financial managers. So we actually delved deeper and deeper into those bits. But therein, there were numerous questions swooping here and there from you guys, which were all answered. Right. So today we're going to proceed with whatever we did. It's just a continuation of what we did on Sunday, right? So that is how we are just moving, right? It is just face-to-face mixed or embedded with online recorded lectures, right? So we talked about one of the decisions that every financial manager tends to take. And one of them is financing decisions, where to get the sources of what funds. We did indicate, a moment, please. Hello? Yes. Good evening. I think because you are not on WhatsApp, so we actually forgot to share. But notwithstanding, let me just send to you right away. Yes, please. The meeting has commenced. No, please. 5. It has started. Yes, please. Right. Guys, a moment. So let me just get this done, then at least you proceed. Just pardon me for that. I need to just sort one of our colleagues out. Okay, I think we can proceed now. Sorry for the interruption, guys. So we did talk extensively about those bits and pieces in the case of financial management. And today I've decided to pick that side for us to consider. We explained clearly that when we're talking about the source of funds, we have two main sources of funds on this planet. We have two, either equity source or debt source, right? Any of the other forms can be categorized under these two. One important thing that I talked about was the difference between the treatment of preference shares. And I explained that we have two main forms of preference shares: redeemable preference shares, irredeemable preference shares. Redeemable preference shares act in line with debt. Irredeemable preference shares act in line with equity. Very important bit for you to look at when you get to issues of cost of capital. With every cost of capital, we're going to talk about those bits and pieces coupled with the Glenn and Miller propositions. Right. So we are talking about financing decisions today. Financing decisions. Right. Just pardon me to do a little reading. So organizations need finance to provide working capital and invest in non-current assets. The main source of funds available might be a retained earnings, that is excess profit. And excess profit is a form of equity. So we can have it as what? A retained earnings, or we can have it as the keys of what? Equity or debt. So let me indicate that here. So it can be a form of equity. So main sources of finance, either equity or debt, the equity or debt. So you can decide to go for funds from equity holders, who are the ordinary shareholders and they have their voting right, they are the real owners of the company. Or you can go for funds from debt holders, which will call for payment of interest, also called finance cost, irrespective of whether you get profit or loss, you are supposed to pay that. I think that some few individuals have joined. Please try as much as possible to mute your speakers so that at least we can kickstart. We can just proceed. I've seen some individuals joining at the moment, and please again try to mute your speakers. I think one is with the name Fifi, one is Dumpty. That's that sort of right. Good. So when we are talking about the sources of finance, we have two main sources of finance. It can be equity source or can be debt source. It can be equity source or can be debt source. Right. Now let's look at one important item: criteria for choosing between sources of funds. Financial managers tends to sit down to decide where do we have to go for funds. There can be a lot of funds available to them, but not all of them will be ideal for them to go for. Now, the point is, why would they sit down to choose between or among sources of funds? They tend to do that because of the cost which comes with the sources of funds. If you tend to haphazardly select any source of fund, the cost which might come up will be very bad, and it will actually affect what the NPV of your project. We did talk about the relationship between weighted average cost of capital, which is a discount factor, with the NPV, and we decided to also relate it to the market value of a company and that of the share price. So I would still like to draw that relationship for you to see clearly, right? When you talk about sources of funds, one important thing that every financial manager tends to consider before saying that I want to go for either an equity source or a debt source, one is going to be the cost that comes with it. It's going to be the cost that comes with it. If a particular source of fund is going to give you a huge cost, it's going to create a huge cost, then you might not consider going for that source of fund. You tend to go for a source of fund which will create a lower cost for you. And at the beginning, we actually indicated that every financial manager goal is to maximize the worth of shareholders. That was what we actually talked about. So main goal of every financial manager, the main goal of every financial manager is to maximize the worth of shareholders. And we did explain what we mean by the worth of shareholders. I think that some few friends have joined who were not with us when we met on weekend. Please, I would want you to link up with me immediately we finish with this lecture for today, because there are some bits and pieces that I have to walk you through, right? So the main goal of every financial manager is to maximize the worth of shareholders, right? Worth of shareholder can be dividends, the dividends he or she is getting. The worth of shareholder can be a capital growth as a result of changes in the value of a share price. But we indicated that one of the ways of maximizing the worth of shareholders is to go for a source of fund which its cost is going to be lower. So if you go for capital, right? If you go for capital and that form of capital is giving you a lower cost to be paid, then at the end of the day, the net present value of that project will have what a higher value. And we know for sure that MPV is having a direct relationship with shareholder wealth maximization. So I did indicate that a decrease, very important, is to be tested, right? A decrease in WACC, a decrease in WACC, right? A decrease in WACC, which is the same as the discount factor. I'll explain more. I think some colleagues just joined and they actually find themselves put a little bit, but I'll still make a provision for you so that it still bring you back to the same position that your friends are. So a decrease in WACC or the discount factor will increase, right? A decrease will increase. Let's make it will increase the NPV of a project. And if the NPV of a project increase, the market value of the company increase. That is in terms of business valuation, the market value of the company increases. So market value of the company increases, and if the market value of a company increase, share prices will increase. Share prices will increase. Right. So these are some relationships that you are supposed to note. It is not part of what exactly we are talking about, but I still wanted to bring it to bear so that individuals who have joined us today will still get that. It's a way of just satisfying you in that regard, right? But what we are talking about today is what are the factors, or the criteria that financial managers are going to consider in deciding whether to go for A, B, C, D source of fund. You will not just wake up and say, I'm going for this source of fund. You are going to consider certain issues before deciding on which of the source of funds you want to opt for. And we are saying that one of the things that financial managers tends to consider is one, the cost, which comes with the source of fund. If the cost is huge, then what happens is that WACC is going to increase. And if WACC increases, the NPV of the project will fall. And if the NPV falls, the market value of the company will fall. If the market value of the company falls, the value of share price will fall. So let's look at it from this context. So in the first context, we are looking at the point where we are considering cost as a basis for the decision maker as to whether he wants to go for this source of fund or not to go for that source of fund. So if you are a financial manager, as you are a student financial manager, if you really want to decide for your company where they are to go for funds, you are not just going to say that we are to go to A, B, C, D. Never. You are actually going to look at certain indicators. And based on that analysis, you now advise your company to go for that source of fund. It can be equity or it can be debt, any of the forms. But one of the things we consider before opting to go for a fund is what we call cost. Right? So if the cost of the fund is higher, it is a bad deal. You are not supposed to go for it. Because if the cost is higher, whatever you're going to use that fund to do might not create benefit which is higher than the cost for you to get some extra gains. And that will be a bad deal. So in deciding on where to go for funds or which funds to go for, one of the indicators is cost. So it's very important for you to look at the relationship that I have drawn right over here. Though at the beginning or the point of inception, it might be complicated to a lot of students. Looking at this relationship, a decrease in WACC leads to an increase in MPV, and an increase in MPV leads to an increase in market value of the company, thereby increasing the share price. It will become very complicated for some students. But when we go through investment appraisal properly, and we tend to also go through issues of business valuation, you still come back to the same position. But for now, just put in your head that anytime we tend to decide on which which funds to go for, cost becomes one of the parameters we consider, right? And every financial manager is looking for any fund which you go for, which is having a lower cost. Nobody would like to go for, let's say, a loan with an increase in interest to be paid, the interest rates. In a normal sense, if we have, let's say, two banks existing, and one bank is saying that come for 5 million Ghana cedi, but you pay an interest rate of 30%. Another is saying that come for that same 5 million Ghana cedi, but you pay 10%. Which of these two will you go for? You are going to opt for a fund which will let you pay a small interest. And here, what are you considering in deciding that you're going for that? It is based on the cost. The cost is the main criteria over here. I do not want to go for a fund which will cause an increase in cost. Please, I can hear some noise on the background, so I advise that we all mute our speakers. Right? Please try as much as possible to do that for me so that I can make a progress. If not, I have to identify where that noise is coming from and take another action. But I don't want to go for that. So please, let's try to mute our speakers so that at least we can move quickly. So we are looking at criteria for choosing between sources of funds, or what are some indicators, what are certain factors that financial managers consider in deciding where to go for a source of fund. First one explained is cost. We are looking at the second factor that financial managers tends to consider in deciding where to go for funds. Please, this aspect is examinable, so you have to really pay attention to that, right? This is one of the questions which has been examined before, and the examiner, your examiner, ICG examiner, can examine it again. So you have to be very alert, right? Duration. Here we are talking about the time period, right? The period, and the period over here has impact on your decision, right? Good. So I would not like to go for a fund which they are going to chase me. Just give me 2 weeks to pay for that. I will opt to go for a fund which they are going to give me that flexibility, that time span, flexible duration, a flexible period to make the payments. So an individual will say that I would want to go for money from Fidelity Bank in instances that Fidelity Bank is going to give him 5 years to pay that. Another individual will opt that I would want to go for money from, let's say, EcoBank, because they will give me 10 years to pay that. If they give you a lot of lifespan, even if things go wrong, you can still recover to pay for that money. In real life situation, people tend to go for or tend to bring in a collateral before they tend to get loans. So if it is a short duration and are not able to pay for that interest and the principal, then that means that collateral, if it is your house, is going to be taken from you. So a lot of individuals tend to look at the option of going for a source of fund based on the duration which comes with the fund, right? So it's important for us to look at the explanation so that at least we can just kickstart, but I just decided to explain to you briefly, right? Finance can be arranged for various time periods. Finance can be arranged for various time periods. Normally, but not invariably, long-term finance is more expensive than short-term finance. If you're borrowing from a bank or from any financial institution and it is going to be a long term, they tend to charge a higher interest rate because it's going to take a lot of time before you pay for that. And that sort of risk of default, that risk of default will be factored into the interest to be paid. So over here, what is actually causing an increase in the interest to be paid, I mean, the long-term finance, is as a result of the risk of default. So if we think that it is going to take a lot of time for you to pay that, probably it is increasing the risk of default. That person might not pay that. That's why a lot of individuals in businesses, they want cash and carry, because cash and carry will avoid what? The risk of default. It will avoid the risk of default. So if you are going to borrow from us, and it's going to take a lot of years for you to pay. In fact, something can happen. That person who came for the money can die. Then things actually turns out to be in a mess. So if it is going to be a long-term finance, we expect to charge what? A higher interest for you to pay. But short-term, let's say 2 weeks, recoverability is what? Better than long-term finance. So with a short-term finance, recoverability of the interest and the principal is really probable than that of a long-term finance. And that will not give us so much headache. At least 2 weeks it will be due, then we take our money. So short-term finance tends to come with a lower interest to be paid, right? So let's proceed. This is because lenders normally perceive the risks, those who are lending, not the borrower. The bank will be the lender. The person going for the loan is the borrower, right? So the lenders, they are the people who are giving the money. The one who is going for the loan or going for the fund is a borrower, right? It's important I explain that terminology. This is because lenders normally perceive the risks as being higher on long-term advances. That's what I've explained. Those who are giving the money think that if it is a long-term finance, it's going to take a lot of years before you pay that. There's an increased risk of default, and they're afraid, they are scared of that. So they charge you a higher rate, such that when you even pay to a particular point and you decide not to continue to pay anymore, at least they've recovered something was substantial, right? So this is because lenders normally perceive the risks as being higher on long-term advances. Long-term finance does, however, carry the advantage of security, whereas sources of short-term funds can often be withdrawn at short notice, right? So in the case of a long-term finance, mostly collateral, tend to charge you a huge collateral to compensate for the risk of default. But in the case of short-term, no huge security is actually taken. If you are going for overdrafts, we will not ask you to actually bring a collateral based on the house or the land that you have. This is just an overdraft, just something small, allowing you to withdraw something in excess of how much you have with us, right? Unless it's really a huge one, but that will not be termed as an overdraft. It's really huge. It is going to be what a long-term debt we are giving to you. Right. So please, you can do that reading, but the bits and pieces of what we are talking about, the main thing that we want to talk about is that in the case of duration, a lot of financial managers consider the duration, the time period, right, in paying for the principal and the interest to decide whether they are to go for debt or to go for equity. And mostly, if it is a long-term finance, the interest you're going to be paid is going to be huge than short-term. So if you know for sure that you cannot pay for that huge interest rate, then you have to what? Opt for which one you are to go for. So these are some of the factors that financial managers consider before deciding on which sources of funds to go for. One was cost, two is duration, right? Then we come to the next item, right? The next issue, term structure of interest rate. This will be looked at later on. Term structure of interest rate. Later on, we will tell you that this is also called yield term to maturity, also called what? The bid rate. Yield term to maturity, right? Sorry for bombarding you with the terminology, but I'm going to explain for you to understand. So yield term to maturity. I'll explain for you to understand. It's nothing, right? Just a terminology in finance which becomes mind-blowing, but by per explanation, it's nothing, right? So just exercise that patience. So yield term to maturity, also called the bid rate, right? So when we talk about term structure of interest rates, we are looking at a relationship, right? We are looking at a relationship between interest rates, and the maturity periods of any loan that we go for. So a term structure of interest rate looks at a relationship between two main items. What are they? The interest on the loan and the maturity. What do you mean by maturity? We are talking about the point of redemption, the point where you are supposed to redeem the principal, the point where the loan they gave you, you are supposed to pay the principal. In most bonds, what happened is that if you go for a bond, if you go issue a bond, right, the issuer of the bond is a borrower, right? Good. So if you issue a bond, what happens is that if it's a 15-year bond, from year 1 to year 15, you'll be paying the interest. And on the year 15, which is the last year, you pay the principal. That is why Modigliani and Miller is having the proposition pertaining to what interest on debt and what have you, talking about tax deductibility, tax shield, and those bits, right? But we are not looking at M&M propositions. We are looking at term structure of interest rate as one of the indicators, one of the factors that financial managers tends to consider before opting to say, I want to go for equity or debt. And we are talking about term structure of interest rate. So you are going to look at the maturity when you are supposed to pay the principal. So if we have, let's say, bond, let me just use this example, bond A, right? Bond A interest rate is 5%, and the maturity period is the next 3 years. We have bond B, bond is a debt, right? We have bond B. Its interest rate is, let's just say 6%, right? 6%. And the point of payment of the principal is going to be what? 7 years, right? Now, the financial manager is going to sit down to look at his pros and cons to decide which of them to go for. Should he go for bond A at paying a coupon of 5% and paying the principal in the next 3 years? Or he should opt for bond B, where he's going to pay 6% coupon rate or interest rate and paying the principal in 7 years' time. So he's just going to look at the relationship between the interest to be paid and the maturity. And that is what we call the term structure of interest rates. Term structure of interest rates. So mostly we are talking about the interest rate in the case of the yield term to maturity, but this term structure of interest rate will be looked at later, and we are going to explain it as a yield curve. Yield curve. So note that the term structure of interest rates is also called, it's a theory, right? It's also called yield curve. Yield curve. It's also called yield curve. Let me write that here. Okay, do not worry. It's also called yield curve. It's also called yield curve. Thank you for that, right? So I've indicated that clearly over here. And when you talk about it, the name tends to sound confusing, but what are we talking about? The sensible thing over here is that when you talk about term structure of interest rate, it looks at the relationship between the interest to be paid on the debt and the maturity of the debt. Two main items. Interest to be paid on the debt, the maturity of the debt. Two main items, right? There are some bits and pieces over here which is very important to talk about. Do we still revisit this terminology again? While short-term funds are usually cheaper than long-term funds, this situation is sometimes reversed and interest rates should be carefully checked. What are we trying to say over here? We have actually talked about duration, right? Please do not confuse the two. When you talk about timing, the duration, it is different from looking at the relationship between the interest rates and the maturity date. Please, you have to get the two clearly so that at least you can proceed. We are saying that while short-term funds are usually cheaper than long-term funds, right? Why are we saying this? In the case of a short-term fund, mostly, we tend to make you pay a smaller interest rate. Though it is just like the duration, but we see over here, we look at relations between the interest to be paid and the maturity. So if you look at the short-term funds, mostly they are cheaper than long-term. Because the short term, you pay a smaller interest rate because the lender knows for sure that it's going to take him just 3 years to get his principal. How much he gave you, 3 years will be due and he will take his money back. Risk of default is not a problem over here. But if it's a long-term funds, which is going to take so many years before you pay, because of the risk of default, he is going to charge you a higher interest rate. And that is why we say that short-term funds are cheaper than long-term funds. But the most important bit over here is that we are looking at the interest to be paid compared with the maturity. We are not looking at only the maturity in this regard. Neither are we only looking at the interest over here. Only. We are looking at the combination of the two. It is different from duration, which actually look at it from one-sided point of view, right? So we move on to the next factor which financial managers tend to consider in deciding which of the sources of funds to go for. We have indicated clearly that we have two main sources of funds. It's going to be equity source or debt source. You can name them. Any source of funds you want to talk about can be categorized under these two main sources of funds, right? So what are you going to actually base on to say that I'm going for either debt or equity? These are the sort of issues that we are going through, right? And the next point is what we call gearing. In normal sense, right? Gearing means an increase in debt. If a company is geared, that means the company is having a lot of debt in its capital structure. I mean, the composition of the capital, the makeup of the capital, which we call capital structure, you see clearly that that company is having more debt than equity. This is really risky. Why? Because if a company goes for more debt, there is an increase in the risk of bankruptcy, right? So we say that an increase in debt increases the risks, increases financial risks, leading to the risk of bankruptcy. Leading to the risk of bankruptcy. Leading to the risk of bankruptcy. You have equity or debt source. You could have opted to go for the funds, right, from equity holders, but you decided to go for the funds from debt holders. If you go for funds from debt holders, as we have already noted, for debt holders, they do not care whether you made a profit or loss. At the end of the period, you are supposed to pay them their interest. But in the case of equity holders, if you go for money from them, you can decide not to even pay them the dividends. The only thing is that you are supposed to explain to them why you don't want to pay them that dividend. And I used Energy Bank as an example. When BOJ talked about capital requirement, increasing capital requirement, they opted not to pay their shareholders any dividends. But you cannot tell that to debt holders. You cannot tell that to debt holders, that the people who gave you the loan, who gave you the debt, you tell them that you are not paying the interest, it is not going to be accepted. So if you tend to go for more debts than equity, you are increasing the risk of bankruptcy. That financial risk tends to increase, and financial risk increases, the risk of bankruptcy of the company increases, right? So if the financial manager realizes that in the capital structure, debt is becoming more, then he can opt not to go for more debt. He can now decide to go for equity as a form of what? A fund, as a source of fund. So the gearing status of the company has impact on the decision of whether to go for debt or to go for equity. Because no financial manager would like to go for what? Debt if there's what? Availability of equity. When we met on Sunday, one of the things that I talked about, which I remember one of our colleagues, Raphael, asked about it. I talked about the instance saying clearly that if you really want to test the competence of your management, go for debt. That is it. If you really want to know that they are competent, do not go for equity source. Go for debt source. Why? Because with the debt source, pressure is on everybody to pay for what? The interest. So that is where if they are not able to convert all the resources into making profits, you actually realize that those guys are not competent. But if you go for equity source, they can just what? Have a discussion with the shareholders, and the shareholders are not going to bother. So going for debt will increase your gearing. And if your gearing increases, then your financial risks will increase. And an increase in financial risks will also increase the risk of bankruptcy. That means the company might what? Go into bankruptcy, liquidation process starts, the registrar opting to cancel the name of the company from his books. That means the company will no more exist, to enter into contract and also what? Booking, enter into contract and also have contracts with other individuals. Cannot sue and be sued. That's sort of issue. So one of the factors that financial managers tends to consider in deciding which of the sources of funds to go for is the gearing status of the company. If the company is highly geared, then they will not go for what? Debts. They will be left with no other alternative than to go for what? Equity. One of the factors that we continue moving on, right? One of the factors that financial managers tend to consider in deciding whether to go for sources of fund A, B, C, or D is what we call accessibility. Accessibility, right? If you are really chasing a particular fund and the fund is not accessible, probability of you getting it is remote. Why do you have to still say that you want to go for that? So we actually base on getting fund based on where we can get it, not where you cannot get it and you still want to go for that. Meanwhile, projects are available and you need money to get them done. So one of the factors that financial managers tends to consider in opting for any of the sources of fund is accessibility, right? If it is accessible, then they will come for it. If it's not accessible, they will not come for it. So the decision of I want equity or debt is based on accessibility. Is it going to be accessible? The fund that I am looking for, is it going to be accessible? If it is not going to be accessible, there's no need for me to waste my time. Right. So at the point of deciding which of the source of funds to go for, I have to sit down and think through. Is this fund going to be accessible? Right? Is it something that I'm supposed to go through a whole lot of processes and procedures before I get it, that I cannot even go through that? If I can't go through that, then I have to just look at elsewhere, accessibility. Right? Good. So that is also one of the factors. You can read the explanation. So at the moment, we have looked at how many points. Cost was the first point. Second one, duration. Third, term structure of interest rates. Fourth, gearing. 5, accessibility, right? One of the things that we can also talk about, which I've indicated it even today, is that sometimes we tend to have some shareholders. If shareholders realize that management are not actually paying heed to whatever they tend to say, mostly the institutional shareholders, they may decide not to support those managers with their equity. and they will force them to go for debt, knowing for sure that a lot of what managers who might not be competent may not be able to pay for that. One of the ways that a shareholder can really consider in warring management, right? We have a way that shareholders can also what punish management is to go for debt, because when they go for debt, pressure will be on managers to gain profits before they can pay the interest out of what the profits before interest and tax, right? So shareholders can decide to also face management's query by punishing them, by not giving them equity, because for the equity, it is a leeway. They can decide to what pay the dividends or not. If you're at the point where you have made massive earnings, the onus is, even in the case of management, to decide how much they have to give you as what shareholder. So still talking about something we talked about the weekend, we indicated that it's not part of it, but I just decided to add up. We indicated that shareholders assume the highest form of risk. Shareholders are also called equity holders, right? Shareholders are also called equity holders, right? So shareholders, I didn't mean to increase this to just say 10, right? Just give me a moment so that at least I can increase to, let's say, 10, right? So at least 10 will be fine. So shareholders are also called what? Equity holders. We say that they assume the highest form of risk. Their risk is huge, right? Than debt holders, So please, this is one of the principles you have to keep in mind. Way back school, when we were going through financial management, one of the chorus we tend to all the time sing is that the higher the risk, the higher the return. The higher the risk, the higher the return. And this principle holds throughout financial management, right? So shareholders tend to assume the highest form of risk. If you're at the point where you have made a massive earnings in profit, we can decide that we are not going to pay you dividends. We are just going to explain that we are using your money to do what? Expansion. And there's nothing you can say. You can't take us to court. You can't do anything. But you cannot tell that to debt holders. They know for sure that they have demands how much interest you are supposed to be paid, whether it rains or shines, you are paying that. That is it. So they do not go through a lot of what? Risks. That is why we tend to say that shareholders assume the highest form of risk. Now, the next item that we are looking at, so the first thing that we tend to talk about is that when we talk about financing decisions, where to go for funds, we have two main sources of going for funds. That is the first point. The first point is that if you want to go for funds, we have two main sources. I'm just explaining where I've got into, right? Throughout, as at this stage, you have talked about two main things. The first one is to just let you know that when you talk about sources of funds, we have two main sources of funds on this planet. We have two main sources of funds on this planet. We have equity or debts. But the financial manager will opt for any of them based on conditions or the situations available. So we decided to move to the second item for the day, which is what factors, what criteria does financial managers consider? That is this point, right? What factors or criteria does financial managers consider in deciding that they want to go for debt or equity? And that is why we came out with these 5 points: cost, duration, term structure of interest rate, gearing, accessibility. So we are going to look at the third thing for the day. But notwithstanding, I've talked about a lot of issues. Because the lecture will be recorded, you can listen to it over and over again. So we are looking at some short-term sources of funds. If you're a manager and you want to go for a short-term source of funds, which you have indicated that it's cheaper. Short-term source of funds are cheaper. We have explained that. These are some examples. We are just letting you know that if you want short-term source of funds because of a cheaper status, these are some of them, right? So you are to know that. One is bank overdrafts. Bank overdraft is a short-term source of fund. Bank loans. We can give you a loan for just 1 year. You pay for that, right? Good. There can also be a better management of working capital. You can manage your working capital to have a cash reserve. You can manage your working capital such that you have an available cash reserve. A cash reserve is a cash that you have which is not having any use. Some companies or some organizations are having a lot of cash reserve hanging on their financial statement. and there's no defined purpose for that. So it's a form of what? Finance. You can use it to do any other thing that you want to do, right? The next one is the next item we are talking about, which is point D, is squeezing trade credit. This is very good, but it turns out to be very what? Disastrous if you do not really get it done properly. Squeezing trade credit. That means that you're going to call for some credit limits in terms of days, but you are not supposed to allow it to what? Exceed. If the supplier decides that pay me in the next 30 days, you are supposed to pay in the next 30 days, because you know what the supplier will tend to do if you decide not to comply with the conditions, right? So if the person decides that how much you are buying from me, you're supposed to pay me 50,000 Ghana cedi, but that 50,000 Ghana cedi, you are not supposed to pay me now. I'm going to give you 3 months for you to pay me that 50,000. Then you can even use that 50,000 to even do something else. And if you can even decide to invest that 50,000 into a risk-free investment, such as treasury bill, even get some interest benefit on it before now going to what? Take that 50,000 to pay for that. So you can squeeze trade credit, but this side is there's supposed to be what? A consensus between you and the supplier, because you know what the supplier might do. In a very severe extent, if it happens that the supplier is a monopoly or is the only person supplying you, you actually know what might happen to you. You actually know what might happen to you, right? So the next item is what you call leasing. Leasing is a form of what? Finance, right? It's a form of finance. And in the old standard IAS 17, we're having operating lease, which was short term, and we're having finance lease. Though in the case of financial reporting, we do not have any form of operating lease anymore. But in the case of financial management, we still have some leases which are in short term and some leases which are in long term. That is it. The last item, which turns out to be a short-term source of fund, is what we call sale and leaseback. Sale and leaseback. You can sell your property to somebody and later on lease that property back. This gives you opportunity to have some process of cash in your hands. It helps you get some money in your hands, right? So I can sell my assets, I can sell my car to an individual, then I get revenue for selling the car. That is the process of sale or the process of disposal. Thereafter, I go and lease back that what asset as a finance lease. And it turns out to be that is my car, because finance leases turns out to be with you for a long period of time, right? Good. So sale and lease back is also a form of what? A short-term sources of fund. It's also a short-term sources of funds, right? So leasing as a source of short-term finance. That is what we are looking at. We decided to pick one of them, I think the complicated one, to actually what? Go through for you to get a concept. So we are looking at leasing as a source of short-term finance, right? So growing in popularity as a source of finance, a lease is a contract. A lease is a contract. I think this one will help those who are studying financial reporting, right? A lease is a contract between a lessor and a lessee for the hire of a particular asset, right? The lessor retains ownership of the assets. He retains what? Ownership of the assets, right? The next item is that the lessor conveys the rights. The lessor conveys the right to use of the assets. So we talk about right of use of an asset when you talk about IFRS 16 when it comes to leases, right? The lessor conveys the rights to the use of the asset to the lessee for an agreed period. That means that the one who is leasing the asset will give it to the owner of the property, who is the lessor, giving his asset to an individual who is called the lessee. The lessor is going to give his asset to you for a particular short period. He's giving you the right to use his assets, and that's what they call the right of use. So in every leasing arrangement, we should see somebody called a lessor giving another person who is a lessee that right to use his assets. And that's what they call the right of use of the assets, right? And the next one is that in return, the lessor receives specified what? Rental payment. The lessor receives specified rental payment. Leasing bit turns out to be complicated for students. That is why we decided to pick it up to explain it in detail. Leasing is a means of financing the use of capital equipment. The underlying principle being that the use is more important than the ownership. So over here, if you are the owner, right? So we have some guys who tend to exist, but they do not have, you see them wearing some trousers, meanwhile they are not the owners of the trousers. But what happened is that if that trousers is going to be used for 15 years and they are to use it for 13 years, you can be the owner, but the benefit which comes with the use of the asset, you are not getting it. So here we are trying to say that the point of usage of the asset is better than the ownership. And mostly when it comes to issues of leasing arrangement, the owner will be different from the user of the assets. The lessee will be using the asset. Though you own it, I'll be paying rent house, but I'll be the person to be using the asset to get my what? My own benefits. Right? So it is a medium-term financial arrangement, usually from 1 to 10 years. Mostly, some individuals tend to look at it in the medium term. They say 1 to 10 years. It can be just 1 year. It can be 6 weeks. It can be 3 weeks in normal situations. Right. So we decided to look at operating lease. This issue tends to hold were actually in existence in financial reporting in the case of IAS 17, but that standard was revised, giving us IFRS 16. So these things, you will not see it in financial reporting, but it turns out to be something which still happens in financial management, operating lease. So we have explained that we have two main types of lease. We have operating lease, we have finance lease, right? So let's explain operating lease, right? Good. So some conditions. We can look at operating lease in the case of the lease period, right? Good. So in the case of an operating lease, we are saying that the lease period is less than the useful life of the asset. What are we trying to say here? Here, for clarity's sake, we are saying that if the asset is having, let's say, 7 years useful life, if the asset is having, let's say, 7 years useful life, 7 years useful life, right? The individual is going to use this asset based on the lease period, let's say what, 2 years. That is when it is what, an operating lease. The old standard will say that if an asset is having 7 years useful life and it's used for 2 years, not a substantial portion of the useful life of the asset, then that asset will go through what you call an operating lease. But if it is 7 years, if it is a 7 years asset, that means that asset is having a useful life of 7 years. And I tend to use this for 6.5 what years, 6.5 what years. Then barely I've used the asset. I tell you, some individuals are staying in homes. You might think that they are the owners of that houses because they have leased that asset for long years and they are still staying in it. Sometimes it will become very difficult for you to differentiate between the owner and the user of the asset, right? It turns out to be like that. Some individuals also rented some cars. They're using it for about 10 years. You might think that they are the owner of the cars or that particular car. Meanwhile, the owner is existing, right? So if it is 7 years and we're using it for just 2 years, operating lease. If it's 7 years and we're using it almost close to the 7 years, barely, then it turns out to be what? A finance lease, right? It turns out to be a finance lease in financial management. But in financial reporting, we don't have operating lease anymore, right? So let's proceed with the next item. So we have talked about the lease period. Let's move on. The leaseur's what? Business. The leaseur's business. What does the leaseur does in the case of, or what does it do in the case of operating lease? So that's what we are looking at. We look at the leaseur's business. The leaseur may very well carry on a trade in this type of what? Asset. What happened is that he's still going to be the owner of the assets. That is his own business. And is to ensure that there's all the time maintenance or repairs to that property. He will still be the person to be dealing with the repairs. And that repairs and maintenance he's going to do will create the risks and the rewards. So the next item is the risks and rewards, which the leaseor is the one responsible for repairs and maintenance. But in the case of a finance lease, it is rather the lessee who is responsible for the repairs and maintenance of the asset. Cancellation. Operating lease. The lease can sometimes be cancelled at short notice. If it's operating lease, we can also cancel it at what? A short notice. right? The substance of an operating lease is the short-term rental of the assets. The main focal point of an operating lease is that this asset is leased at a short duration, right? So if in the case of the old standard, IAS 17, it never defined what you call a financing lease. It actually explained that any other asset which is not an operating lease is said to be a finance lease. But in the case of the revised standard, which is what we are going to consider in the case of those who have signed up for financial reporting, we are going to talk about IFRS 16, which is the revised form of the standard, right? So we actually looked at the short-term sources of funds, but we decided to pick the complicated one and explain them. Leasing, we picked leasing and we have explained it in its what sense. We are going to pick the next one, which is sale and lease back. This tends to be terminologies which tends to worry a lot of students, so we decided to pick them one after the other and expatiate on that, right? A company that owns its own premises, right, can obtain finance by selling the property for cash. So he's the owner of the property. He will sell that property to get cash. And what happens? And renting it back off the acquirer, which would typically be an insurance company or a pension fund. So we are saying that with a sale and lease back, a company that owns its own premises can obtain finance by selling the property for cash. You are the owner, but you sold your property. Then after selling the property, what did you do? You went back to what? Lease that back, right? So that is the meaning of that. Let's just make a move before we look at long-term sources of fund. Although this can provide an immediate source of cash, often more than could be obtained from a mortgage, there are a number of disadvantages to going for what we call a sale and leaseback, right? So we say comparatively, if you compare sale and leaseback to mortgages, if you compare sale and leaseback to mortgages, we are saying that sale and leaseback is better than mortgages, but it is having some disadvantages. And we are looking at the disadvantages of sale and leaseback. So over here, what are we looking at? Disadvantages. Let me write it boldly here so the student can get the most out of it. Disadvantages of sale and leaseback. Disadvantages of sale and leaseback. So that is exactly what we are going to talk about in this section. Disadvantages of sale and leaseback. Please, we are not saying that this is in the entire sense the disadvantages of sale and leaseback. So one, the company loses ownership of the property and will therefore miss out on any appreciation in the property's future value. So that is one disadvantage. The company loses ownership. If you sell it and lease it back, you cannot say you are the owner of the property anymore, right? So if you go through a sale and lease back, those will give you some money as a source of fund. But what happened is that you, the one who was the owner of the property, you no more be the owner. That is it. So if you're going through that, you have to be very careful. You cannot sell it, then lease it back, then still say that you are the owner. It doesn't happen. Meanwhile, you have taken the money which comes with it. Second disadvantage, the company will have to sign a rental agreement, usually for at least 50 years, thereby committing the company to occupying the property for many years ahead. This can be restricting. That means that you are creating discomfort for yourself. The disadvantage we are trying to talk about here is that if you go to say a lease back, you're going to create discomfort for yourself because you're going to sign a contract or an agreement, and the contract is not going to be all in your case. It is not going to be favorable to you. And another individual is going to look at what is going to favor him or her. So because you are the owner, an owner of a property, you don't care. There's no restriction to you. But if you should sell it and lease it back, somebody is now going to tell you or speak his own language to you, and you have to accept it because now you do not have any choice. You sold your asset and you've released the asset back. You are not the owner. The person who is not the owner will tell you his or her what? His English. That is it, right? So we make a move to point 3. The future borrowing capacity of the company will reduce as property is a common asset used to provide security for debt finance. If you go through issues of what sale and lease back, that is what a disadvantage, which tends to affect what the security coming with what that. Now you've sold that asset. Can you use that asset as a collateral? No bank will accept a lease asset as a collateral. We are looking at properties that you have ownership, you have control over it. In that case, if we're coming for debt finance, you present that as a collateral. So here, let me put it in the right context. Collateralization is affected. Collateralization, right? Collateralization, right, is affected. You cannot use a lease asset as a collateral. So if you were the owner, you could have used that property that you have ownership of to serve as a collateral. But if you should sell that asset and lease it back, that asset can never be used in the future date as a collateral. So a sale and lease back will restrict you from having collaterals to be used in securing what? Debts. So sale and lease back is having that disadvantage because we do not accept a lease asset as a collateral. Next item, any rent will be subject to regular reviews and will most likely increase over time, right? If you want to continue leasing, the first day you came for it was 1,000, the next day after review is going to increase, creating a lot of discomfort. So these are disadvantages of sale and lease back. Do not be so much happy that you can sell your own property, get some money, and still go and lease it back. Some instances, the individual you sell to the individual, and there's going to be an unforeseen circumstance that the person cannot lease it back to you. So it is not an ideal situation for you to go for. It's not an ideal situation, but some individual tends to look at it in some worst case scenarios, right? So we have talked about short-term sources of funds. We have talked about short-term sources of funds. We decided to even pick two of the short-term sources of funds and elaborate it in detail. We are now moving in to look at long-term sources of funds. Long-term sources of funds. This turns out to be a dilemma for a lot of financial managers. And please do not look at it that you are actually learning to write an exam, right? Try to be in the situation of a financial manager. If at the moment I'm looking for a source of funds, will I go for short-term or long-term? If I'm going for short-term or long-term, what are the factors I'm going to consider to say I'm going for that? Please sit down and be a little bit natural with the situation. A lot of students who do not get passes in professional qualification they learn do not actually pretend that they are financial managers. They tend to learn it in a haphazard manner. I'm just going to write an exam, so it ends there. You will not appreciate the full bit of what you are learning if you tend to go by that, right? Good. So we are looking at long-term finance sources, equity or debt, long-term sources of funds. So you can have equity, it can be debt. It does not necessarily mean that the short-term will also not be equity or debt. The short-term source of funds can also be equity or debt. In that case, if it is equity, it's short-term. If it is debt, it's a short-term. That's sort of like trade credit. Trade credit is a form of equity. It's short-term. Debt here can also be short-term. If we are talking about short-term source of funds, we still have it two main, equity or debt. If it's a short-term source of fund, equity will be short-term equity, debt will be short-term debt. If it's a long-term source of fund, equity will be long-term equity, debt will be long-term debt. That is it. So please, it doesn't mean that the student will see equity and debt under long-term finance, and we say that so does it mean that the short-term we don't have equity and debt? We still have equity and debt under what? The short-term. You can have a look at it, right? Based on what we talked about. Bank overdraft, bank loan, these are all what? These are all what? Debt, short-term debt. Bank overdraft, bank loan, issues of leasing, they are all what? Short-term debts. But it comes to issues like squeezing trade credit, better management of working capital, like retained earnings, which is a part of equity. They are what? Short-term, right? So please get that concept right. So long-term source of funds, we are looking at equity, right? Very important bit over here. Equity finance is the investment in a company. It's the investment in a company by the ordinary shareholders. So when you talk about equity finance, we are getting this money from ordinary shareholders who are the real owners of the business. And because they are the real owners of the business, they tend to have voting rights. So equity finance is the investment in a company by the ordinary shareholders, represented by the issued ordinary share capital plus reserves, right? Plus reserves. There are other types of share capital relating to various types of preference shares. So we can say that a preference share is a form of what? Equity. But here, what type of preference share are we talking about? We are talking about irredeemable preference share. Irredeemable preference share. Irredeemable preference shares. Irredeemable preference shares are equity. Be very careful. We are not talking about any preference share. We're talking about irredeemable preference share. It's a form of equity because you're not going to pay back. So it's just in the form of equity. But a redeemable preference share, redeemable preference shares, redeemable preference shares are a form of what? Debts, are a form of debts. So please take note of the difference, right? So when you talk about equity, a preference share as equity, we are not talking about redeemable preference shares. Instead, we are talking about the preference share which is irredeemable. That is what? A form of equity. Raising equity, raising equity. If you want to increase the equity of a company, how do you increase the equity of a company? So we are looking at, there are three main sources of equity funds. Three main sources of equity funds in general, right? We have internally generated funds, which are also called retained earnings. Retained earnings are also called income surplus. Retained earnings are also called what? Income surplus. Income surplus. Also called income surplus. It is the part of the profit which we have retained, right? So if a company is having profit after tax, right? Profit after tax can be divided into two, right? Profit after tax, part is paid as what? Dividends. Part is paid as dividends and part is retained. And part is retained. Part is retained. The portion which is retained, that's what we call the retained earnings. So retained profits or earnings, which is also called what? Income surplus. Which is also called income surplus. So if a company tends to have a profit after tax, part of the profit after tax is paid as dividends to the ordinary shareholders, and part of it is paid. Part of it is kept in the organization. Part of it is retained in the organization, and that is a form of equity. So we are saying that one of the sources of equity finance is an internally generated fund, which is a retained earnings. Another form of equity is right issue, right issue, right issue. And this came up the first time we were talking about these bits and pieces. A right issue is an offer to existing shareholders. So the company who needs extra capital, who needs extra funds, is actually going to write, is actually going to communicate to the already existing shareholders that they have to subscribe for new shares, giving the company new what? Funds, right? We only give them a share certificate, they are going to give us more money for us to use it to go and what? Pay for that. But it's based on the shares we give them, do not alter the share proportions that they have. We will give it to them based on their share proportions. So at the initial sense, if the share proportions was 3:2, 3:2, at the end of the sharing, it will still be 3:2. Right. So a right issue is an offer to existing shareholders to subscribe for new shares at a discount to the current market value. So we let them pay something lower than the current market value of the price of the share in proportion to their existing shareholdings. In proportions to the existing share. So we do not deviate from the normal, right? So that means that in right issue, who was the majority shareholder will continue to be a majority shareholder. The individual who was the institutional shareholder becomes still the institutional shareholder. Because the additional shares, and based on the amount to give, is still based on the existing shareholders, right? So nothing changes. So we have talked about equity as a form of long-term debt, and we are talking about minor, or let's just say subgroups under that source of what fund as equity. Internally generated fund as retained earnings. Second one, right issue. The last bit. new external share issues. That is placings, offer for sale, right? You can look at this bit. Or IPO, IPO. Let me indicate that. Initial public offering, IPO. You can get new funds through what you call, wait, okay, make okay. That's okay, that's it. Initial public offering, initial public offering. That is what IPO, initial public offering. Initial public offering. That is what IPO. Right. So IPO only comes up when we are existing in the primary markets. So IPO is still important to talk about. IPO exists only when we are operating, in a primary market. A primary market. A primary market is the first time sale of what? First time sale of shares. So if a company is new and is now selling its shares for the first time, we call it what? An IPO. And an IPO tends to only exist in the primary market. But if after those individuals who bought it the first time are selling it, right, to other shareholders, then we will not call it what? An IPO. So it can be placement or an offer for sale. An offer for sale. So that's also a means of getting that. Now, let's go further to explain what do you mean by placing. Let's go further to explain what we mean by placing. A placing may be used for smaller issues of shares. Please just be with me. We'll get to the point of solving questions. In the financial management, we have to start with the reading aspect, and basically that is what we are looking at. But do not say that you're not going to respect it. Please just follow, right? You will need it in some sections of the paper, because your paper is not 100% calculation. It is partly calculation, partly theoretical, right? A placing may be used for smaller issues of shares up to $15 million in value, right? The bank advising the company select institutional investors to whom the shares are placed or sold. So if the general public wishes to acquire shares, they must buy them from the institutions. That is through what? Placing, right? So the shares is actually given to a particular company for the company to make the sale on their behalf. So there are two companies over here. The main company will be existing, but their shares is given to another company to do the selling on their behalf, selling to the public, right? So let's look at the next one, public offer. Public offer. A public offer is an invitation to apply for shares in a company based upon information contained in a prospectus, either a fixed price or by tender. So there can be a public offer, right? In that regard. Now let's explain what you mean by a fixed price offer. A fixed price offer. The name actually explains itself. A fixed price offer. The name actually explains itself. The name actually explains itself. Right? Shares are offered at a fixed price. Shares are offered at a fixed price to the general public, including institutions. Details of the offer documents are published in a prospectus for the issue. So basically, the value of the shares is at a fixed price. It is not going to be a price which is going to be variable, or it's not going to be a price of a share which is going to change. It's going to be fixed. It's going to be fixed, right? Offer for sale by tender. Offer for sale by tender. Just like tendering for an engagement, you can also tender to purchase the shares. Shares are offered to the general public, including institutions, but not fixed price, right? So the issue that it is offered to the public, but not at a fixed price. That means it can change. Potential investors bid for shares at a price of their choosing. The striking price, also called exercise price. Let me indicate that over here. Strike price, right? You look at this when you talk about risk management later on in the financial management paper. So though there's a terminology which has come up earlier on, but it's still important for you to hear. A strike price is also called an exercise price. It's also called exercise price. Please, there's noise from one of us, our background. If we can mute our speakers, I think it will be really helpful, right? So we are saying that with an offer for sale by tender, the shares are offered to the public not at a fixed price. So a strike price is also called an exercise price. That is how much the public is going to buy that shares. And just give it that name. Somebody is supposed to say that is selling price, but we do not call it selling price in this context. If you are selling shares, we rather call it a strike price. The value of the shares that the public tends to buy the shares is called a strike price. And the strike price is also called an exercise price. Right? Choosing between sources of equity, right? Some of the conditions that we also consider, right? Factors considered, right? So let me just give it another caption. Factors, this tends to be examinable by the CA examiner. So please just have to be very alert. Factors considered in choosing equity form of funds. What factors do we consider? Right? You have actually decided that you want to go for equity. But even at the point of going for equity, you have types of equity. So what are the factors you are going to consider in selecting a particular type of equity? That is what we are talking about. Please, these are very important. It turns out to be examinable, right? So every bit that we are talking about in this document is very important to you, please. And you are to treat everything with respect, right? So let me indicate over here. If I say examinable here, highly a student will say that, Henry, doesn't mean the other ones you talked about are not examinable. Please, they are all examinable, right? But I just didn't do that in my earlier submissions. So I just decided to bring it in. So at every point in time, I tend to indicate that. So at the point where we have decided that we want to go for equity, knowing very well that we have types of equity. Now, which of them are we supposed to go for? We are going to look at certain things to consider before saying that although we are going for this for equity, but this is the type of equity we are going for. One, accessibility of finance. So in both instances, whether you are going for equity, debt, or whatever point of view, we are still talking about the accessibility of the funds, right? So let's look at some explanation over here, at least to help individuals. The ability of a company to raise equity finance is restricted by its access to the general market for funds. Thus, whilst quoted companies is a company which is listed. So the stock market or the stock exchange is easy. You can just buy that, right? Whilst quoted companies are able to use any of the sources, an unquoted company is restricted to right issues and private placements. Please note this important distinction between quoted companies. So what are we talking about here? We are trying to just give you the differences between quoted companies and unquoted companies. We are just trying to tell you one of the differentiation, right? So over here, though the point is talking about accessibility, but the explanation is giving students an alert that there's a difference between quoted companies and unquoted companies. So let me indicate that here. A difference between quoted and unquoted companies. Quoted and unquoted companies, right? Quoted and unquoted companies. So at the moment, though this just came up, but we know for sure that in the case of quoted companies, they can use all means to raise their funds. But in the case of unquoted companies, they cannot use right issues and private placement. So please note this. It wasn't an issue that we're looking at, but the explanation brought it up. So it's important for us to consider. But the main point is accessibility of finance or accessibility to finance. Next one, amount of finance. The amount of finance that we are going for in terms of equity, because some form of equity is just very small, right? Some are also huge, right? And we can talk about shares. as a huge form of finance. Some, like retained earnings, depending on the status of the company, will actually influence, will actually tell us the status of that, right? Trade credits, how much trade credits can you go for? Get some small amounts, right? So the amount of finance, if you need a huge finance, if you need a huge equity finance, then it's better you go for what? Issuing shares on the stock market. That is what is going to give you huge equity finance. But if you want to go for a small equity finance, right, you can go for trade credit, right? Look at the next point, cost of issue process or the cost of issue procedures. And here, issuing shares on the stock market, the procedures are long, right? So let me explain this too. We have something called the dark pool trading system versus stock market or stock exchange trading. Stock market into bracket exchange, stock market into bracket exchange trading, right? Now, when you talk about stock market trading is mostly exhibited by, let me just change the color a little bit so that it will help us. Stock market trading mostly used by quoted companies. A quoted company is a company which can float its shares on the stock market. A dark pool trading system is a private way of selling shares, right? Over here in the dark pool trading system, the company will actually look around, contact some rich individuals, then talk to them, obtain the funds that they need, and it ends there. So that's what we call a dark pool. It is not open. If it is open, we will not use the word dark. So a dark pool trading system is a private way of what? Selling shares, and mostly used by unquoted companies. Unquoted companies. It is mostly used by unquoted companies. Right. So the cost of the issue process, sometimes you need to get the services of a broker. And if the broker is charging you huge, you might decide not to go for it. So broker fees, we're talking about broker fees, right? As a cost of issue, all right? We're also called what? Issue cost, issue cost. Sometimes the paper fees, the filings, fees that you pay before you get that form of equity, my friend, you might not be interested in going for that form of equity, right? Good. So we are talking about the cost of issue. Here we are issuing equity. So a cost which comes with issue throughout the process can be a brokerage fee or an issue cost. Any of them, paper fee, filing fees, those bits and pieces. But this point has actually brought to bear the distinction between dark pool trading system and buying shares in the open, which is the stock market. So I've also explained to you per this recording the difference between a dark pool trading system and a stock market or stock exchange trading. Let's move on to the next point, pricing of the issue. Pricing of the issue. Let's look at some explanation over here to keep ourselves satisfied. One of the most difficult problems in making a new issue to the public is setting the price correctly. If it is too high, the issue will not be fully taken up and will be left with the underwriters. And if it is underpriced, some of the benefits of the project for which the finance is being raised will accrue to the new shareholders and not to the old. What are we trying to say over here? We tend out to have individuals who help us in selling shares, And those individuals who help us in selling shares, sometimes they tend to add a little bit of value to how much the price of the share that they are selling. And it sometimes make it difficult for just any individual or any company to just say that this is the type of share that I want to go for. So depending on the situations available, based on how much you think you can pay, how much value is going to be added before you buy that shares, will influence your decision whether you want to go and what get or go for this particular type of equity. So pricing of the issue will also be what? Very important, because the pricing by issuing the shares, the pricing, a benefit, a portion will go to the underwriters, right? Will go to the underwriters. So if you price it properly, fine. But it turns out to be that it turns out to lead to an increase in what? The cost. It is a price to somebody, but it is a cost to another person. The company which is selling their shares, they see it as a selling price, but the other person sees it as a cost price. So I tend to tell students that it is not every point in time where we say that selling price is different from a cost price. If we're looking at it from one person perspective, selling price is different from cost price. But if we're looking at it from the perspective of two individuals, let's just assume this. Before you go to somebody's shop to buy a tin of milk, that person has already priced his what? Tin of milk. The person who is selling, does the person actually sees it as what? Does the person actually sees it as a cost? No, he sees it as a selling price. The person selling that 5 Ghana cedi is a selling price. The person who is coming to buy that same 5 Ghana cedi, which is a selling price to the seller, that person who is coming to buy that tin of milk, see it as a cost price. Are we not still talking about this 5 Ghana cedi? So it is not all the time where we say that selling price is different from cost price. It depends on the situation in question. But if it is just one individual, I will be the same person to make the milk. That is when I will incur cost. Then I now add my profit element to get a selling price. So in one individual alone, selling price will be different from cost price. But in the case of sellers and buyers, it will be a selling price to the seller. That same selling price become a cost price to the buyer. That is it, right? So one of the indicators that we also consider in the decision of what type of equity to go for is what we call control. It's what we call control, right? So let's explain a little bit. When you talk about control, control only comes in when you intend to buy what? Shares. But we are not looking at it in the case of controls do not come in when there's a right issue or there's what? Retained earnings. Because the right issue, somebody just asked a question. Henry, are we not buying shares when it comes to right issue? You are buying those shares at a discount. And your shareholding proportion does not change. So if we're having 50% and we sell extra shares, you still have 50%. There has not been any change in the number of the percentage that you have. So if there has not been a change in the percentage that you have, is it contributing to control? Though financial reporting students, we talk about consolidation and these bits and pieces will come up again. But those who are not booking for financial reporting, please just understand that when you talk about control, that is when an individual is having more than 50% of the shares of a company. And right issue it doesn't cause a change in the shareholding. So whoever was having the majority shares at the end of the right issue still be the same person. There's no change, right? So it does not have any impact on control. But if we're going for new shares or existing shareholders, individuals are actually buying new shares, the buying or the purchase of the new shares will give them control. So that's what we are talking about. There's no change in the shareholders. There's no change in the shareholders with internally generated funds and right issue. Insofar as they are taken up by the existing shareholders, right? Good. So that is the explanation I've given. So we now come to debts. There are many sources of long-term debt. These include the following: bonds. Very important, right? A bond is a written acknowledgement of a debt by a company, normally containing provisions as to payment of interest and the terms of repayment of the principal. As I explained, if you go for a 15-year bond, you'll be paying the interest from year 1 to year 15. And on the 15th year, that is when you pay the principal, right? M&M propositions will be talked about later on. Bonds are also known as what? Debentures, right? That is debentures, loan notes, loan stock. These are all forms of what? Bonds. They are traded on stock markets in much the same way as shares. Bonds are usually denominated in blocks of 100 nominal value. That is why all the time the bonds are sold in at par. That is 100, 100, 100. But in some contexts, in some markets, it can be what? Sold in thousands or can be sold in 10,000s, right? Good. Bonds may be secured or unsecured, right? If it's secured, that means there's what? A security. That's a collateral. If it's unsecured, that means there's no security. There's no collateral. So we say unsecured, not secured, means no what? Security, means no collateral. Secured debt will carry a charge over it. And that charge can be in the case of what? A specified or specific what? Assets. What are we saying? Secured debts are having securities or they're having collaterals. And the collaterals can be buildings, lands and buildings. That's what they're talking about over here, right? So secured debt all the time have collaterals. And the collateral can be land and buildings or any form of what? Assets. But here we stated that a lease asset cannot be used as a collateral because you are not the owner. So how can you use it? Then a lot of people go for a lot of debt and then we use lease assets for that. That is why the banks tend to identify, let you show them any documentation of ownership before they actually agree to accept it as what? A collateral, not any other asset, right? So we are saying that bonds may be redeemable or irredeemable. Bonds may be redeemable or irredeemable. Deep discount bonds. Let's explain. These are some terminologies. Just you have to learn it just in case, right? Deep discount bonds. Deep discount bonds. Deep discount bonds are loan notes issued at a price which is at a large discount to the nominal value of the notes. So it's a large discount. So it's a deep discount. A discount is a reduction, right? Good. Now, let me bring this up, right? If a coupon rate, you might not understand it 100% at this stage, but later on it will come up. But it's good for me to bring it up for you to ring in your ears over and over again. If a coupon rate is lesser than the yield term to maturity, let me just use discount factor, right? YTM. YTM means yield term to maturity. A yield term to maturity is the discount factor, right? So yield term to maturity. You understand this later on, right? Yield term to maturity. Then we say that that bond is issued at a discount. What are we trying to say over here? If the coupon rate of a bond is, let's say, 5%, if the coupon rate of a bond is 5%, while the discount factor or the yield term is, let's say, you're just using an example, right? Let's say 7%. Then so far as the mere fact that the coupon rate is lesser than the discount factor, the YTM, tells us do not even go to any extent. It should let you know that the bond is issued at a discount. Right? Let's look at the next. These are important terminologies in what? Important issues in financial management. If a coupon rate is higher than the discount factor, right? DF is discount factor, which is also called the yield term to maturity, which is also called the yield term to maturity. Then we say that this bond is issued at what? A premium. This bond is issued at a premium. It's issued at a premium. For example, if the coupon rate is 8% and the discount factor, the YTM, is 3%, then we need not to actually look at any analysis. Because the coupon rate is higher than the discount factor, the bond is issued at a premium. Later on, we will see why it is so. We see why this principle holds. So when you talk about a deep discount, that means the discount is deep. When you say the discount is deep, that means you're talking about large what? Discount. And the word discount means reduction. Right. So deep discount bonds are loan notes issued at a price which is at a large discount. It's at a large discount. It's at a large reduction to the nominal value of the notes. Right? So look at how much it will be in the market. It is lower than that. And which will be redeemable at par or above par when they eventually what? Mature. When they eventually what? Mature. We move on to zero coupon bonds. Zero coupon bonds. Right? We get to a particular stage, then we bring the meeting to an end. This document is entirely 38 pages, right? 38 pages. Zero coupon bonds. Zero coupon bonds. Zero coupon bonds are bonds that are issued at a discount to their redemption value, but no interest is paid on them. That is the only difference between what? A deep discount bond and a zero coupon bond. They are all issued at what? A discount. Deep discount bonds, zero coupon bonds are all issued at a discount. Just that in a deep discount bond, the discount is huge, right? But with a zero coupon bond, there is no payment on what? Of interest on them. It's just the principal, right? Good. We've already talked about leasing, so I'll not talk about that bit over here, right? We explained operating lease. Here we are talking about finance lease. We talk about this bit. I gave that extension, so please, you can read that. You can read this. The opposite of the operating lease is a finance lease. So this has already been captured. Now let's look at another form of what? Equity, which is called venture capital. Venture capital. This is barely reading. So over here, students who are all the time in love with calculations will not see this to be enjoyable. But I tell you, your paper is partly calculation, partly theory. So you got to be prepared, right? A lot of students are not passing the financial management because they are thinking all the time when it comes to issues of financial management, they are good to calculate. You go there and you are surprised. Theory question, 5 marks, you can't answer. Right? For the calculation, all the time going to be complicated. So it's the theory we look at. Passing financial management needs a good grasp of theory. That is it. That's the simple secret, the golden rule secret. That is it. Nobody can confess that in ICAG, he or she passed financial management without doing well with the theory. A lot of them pass the financial management when they tend to do well in the theory. Then the case of the calculation, it turns out to be a lukewarm sort of, right? A misfeeling. They pass. Some even getting 60s and 70s. But those who just go there for calculation turns out to what? Mess up big time. Right? The paper is not 100% calculation. Venture capital is the provision of risk-bearing capital, usually in the form of a participation in equity to companies with high growth potential. Venture capitalists provide startup and late-stage growth finance, usually for smaller firms. So an individual can target a startup, then knowing for sure that there are a lot of prospect with this startup, invest into it, make big time, and later on find their exit strategy. That is the case of venture capitalists. So if you tend to follow a venture capitalist, it is very enjoyable because they do not make their mistake. They actually make the analysis to ensure that where they are going to be a lot of benefits exceeding costs before they go. And mostly they target startups, do appraisal on the startups, beneficial startups of that matter. So before they go in there, and when they make it, and people are now learning from them, they now find their exit strategy. These are people who are very smart. We tend to have a lot of them who tend to go into forex trading. So if you see them buying more of a particular shares, you should also buy more of that shares because you get a lot of benefits. They do not make mistake. Never. Right? Advantages of debts. Advantages of debts. Advantages of what? Debts. Advantages of debt. So we are looking at some advantages of debts. We are saying that debt is cheap. Here we look at it later on because of the principles of Modigliani and what? Miller. Because of the principles of Modigliani and Miller. Because of the principles of Modigliani and Miller, right? So Modigliani and Miller states that Modigliani and Miller states that because there's a tax shield, right? I will explain that. So the existence of a tax shield, right, makes interest paid on debts cheaper, right? Good. So if you are to pay, mostly in calculating cost of debts, right? We tend to calculate it as I, or the interest, into brackets 1 minus T. 1 minus what? T. The T represents tax. So if I've gone for a debt and I'm supposed to pay 7% on that debt, meanwhile, there exists what? A tax of 30%. Meanwhile, there exists a tax of 30%. 30% is the same as 30 over 100, and 30 over 100 is 0.30. So at the end of the day, instead of paying that 7%, I will now end up paying what? 4.9%. I'll now end up paying 4.9%. So in a tax environment, which a lot of countries tends out to have tax systems, instead of paying the 7% on the debts you go for, you end up paying 4.9 instead. All right, we tend to have one political party in the case of Ghana, where earlier on, when they were in opposition, were talking about issues of don't go for that. But they came in power sometime and they were going for that. When one of their proponents, who was all the time talking about don't go for that in the previous instance, now going for that, was asked why they are going for that. He actually explained using backing it based on M&M theory, basing it on M&M theory. And that's how smart politicians tend out to be. That though you go for debt, but the interest you pay on the debt is tax deductible. Interest paid on debt is tax deductible. Interest paid on debt is tax deductible. It's tax deductible. So why don't you go for debt if debt is cheaper? And how much you pay is less tax. That is not paying 7%, you pay 4.9. Then debt is what? Cheaper. But M&M still stated that though that is cheaper because of the existence of tax shield, which creates what you call tax deductibility, too much debt increase the risk of what? Bankruptcy. And you have to be very careful. So do not think that what because there's existence of tax, so you are going for what? A lot of debt, to ensure that your capital structure is more geared. If your capital structure is more geared, financial risk increases, risk of bankruptcy increases, right? So in a normal sense, debt is cheaper. In a normal sense, debt is cheaper than equity. And I've explained to you why debt is cheaper, because of the financial assumption leveled by Modigliani and Miller propositions, right? We look at it later on. Modigliani and Miller actually came out with this proposition in 1958. Though in 1963, Modigliani never featured, Miller came to throw more light on this theory. So debt is cheaper, right? So one of the advantages of going for debt is cheaper. Debt is cheaper, right? Next one, the next advantage, cost is limited. Cost is limited to the stipulated interest payment. That means the cost you pay is only based on the period that you have been specified. It doesn't go beyond it, right? Good. The next one, there is no dilution of control when debt is issued. So if you actually go for debt, the one who was having 50% majority shareholder also have the same majority shareholder, right? That is it. There is no dilution of control when debt is issued. We do not talk about control when it comes to debt. Another point is that, another advantage, right, of an advantage of going for debt is that it's a way, it is a way of testing the competence of management. The way of testing the competence of management, right? So we can add this as one of the points to the advantages of going for debt. That going for debt is a way of testing the competence of management. Disadvantages of debt. Disadvantages of debt. Disadvantages of debt. Interest must be paid whatever the earnings of the company, unlike dividends, which can be paid in good years and not in bad years. So if you go for debt, whether you're making profit or loss per year, you have to pay the interest. If you don't pay the interest, court action now comes in. So we are saying that unlike dividends, which is only paid in good years. If the company is making huge profits, then that's when they pay dividend. If they are not making profit, they don't pay any dividends. In the case of debt, you do not have that leeway. You do not have that flexibility, my friend. You lie back. You are supposed to pay that interest. Let's make a move. So it's a disadvantage for going for debt. Point 2, shareholders may be concerned that a geared company, what is a geared company? A geared company is a company which is having more debts in its capital structure than equity. And if a company is more geared, we say that there's an increased risk of what? Financial risk and the risk of bankruptcy. So shareholders may be concerned that a geared company cannot pay all its interest and still pay dividends, and will raise the rate of return that they require from the company to compensate for the increased risks. What are we talking about here? Guys, we are talking about Modigliani and Miller proposition, right? M&M theory. M&M theory. It actually says that when shareholders realize that as a company, you have gone for more debts than equity, they are going to know clearly that because you have gone for more debt, you cannot pay all the interest which comes with that debt for a portion to be left to pay them as dividends. So that sort of issues, right? It's campaign, right? They tend to just say that, oh, if this is what you're doing for these debt holders, whilst I'm a shareholder and I'm assuming the highest form of risk, and you are not compensating me with me, the one having the highest form of risk, and you're doing that to the debt holders, then how much you're supposed to give to me as the cost of equity, I'm also going to increase it. So if you tend to go for more debts, you're going to make what shareholders aggrieved. That is the sort of issue. Because you're going to, all the profit you're going to get, you're going to use to pay interest. All the profit you're going to get, you're going to use to pay interest. What part will be left for me to enjoy as dividends? I think you have been unfair. So I also cause an increase in the cost of equity. So going for debt, do not smile if you're going for debt. You're actually creating what? Enemies for yourself. With fixed maturity dates, provision must be made for the repayment of debts. So every time you need to make provision, your financial statement will not look good because you're making provision. It's not easy, right? Long-term debts with its commitment to fixed interest payment may prove a burden, especially if the general level of interest falls. If the general level of interest falls, right? So if you go for a long-term debt and the interest you're paying is fixed, right? That means at the point where some interest rates in the market are falling, you are still paying the higher fixed rate. Unless you only benefit if the interest rate in the market is increasing, right? And you are paying, let's say, still the fixed. Then at that point in time, you are enjoying. But if the interest rate, the loan you are going for comes with the payment of a fixed interest rate, and whilst all others interest rates of debt are going down, yours is still fixed. It is not what beneficial. So that is what we are talking about. Let's end with hybrids. Then God willing, we will continue what later on. But I would advise that you read through. Because in our subsequent meetings, I am just going to pick the most important bit for us to look at. So please, you have to go through that for me. Hybrids. We are talking about hybrids as a form of finance, which are having both equity and debt composition. We looked at equity only. We looked at debt separately. We are now looking at a form of funds, which is having equity and debt composition. It is having the two characteristics, right? It's actually a female and a male at the same time, right? Hybrids. Some types of finance have elements of both debt and equity. Both elements of equity and debt. One, convertible loan notes. So a convertible loan note at this point in time is a loan note, it's a debt. But at the point of redemption, it can be converted to shares, right? So that is the meaning of a convertible loan notes. Convertible loan. A loan note is a debt, but because it's convertible at the maturity date, this loan note, which is a debt, we can convert it to shares. Next one, loan note with warrants. Loan note with warrants. Loan note with warrants. Warrants give the holder the right to subscribe at a fixed future date for a certain number of ordinary shares at a predetermined price. So it is just similar to convertible loan, but this is predetermined, right? And it gives you the right to subscribe to that, right? But this is predetermined. But in the case of a convertible loan note, it is either at a predetermined price or a predetermined ratio. So know the difference. Now, this concept has been examined in the CA Financial Management about 3 times. Islamic finance. Islamic finance. I'm going to explain it in its entire sense. Then thereafter, we look at just bringing our meeting to an end. So I'm going to end our financial market, right? So I'll end over here, financial market, right? That is where I'll bring the meeting for today to an end, right? Good. So Islamic finance. Now, there's a difference between Islamic finance and a conventional finance. Let me just say a conventional finance is like the normal finance that we know, where we go for debts, then it is important for us to pay the interest on the debts. Now, that is what you call conventional finance. But we have a form of finance called Islamic finance, right? Now, this Islamic finance is based on the law called the Sharia law. According to the Sharia law, interest, which is called riba, right? So let me put that according to the Sharia law. According to the Sharia law, interest into brackets, let me just put into bracket riba. That is the name, right? That's how they call it. According to the Islamic law, which is called the Sharia law, interest into bracket riba is forbidden. Never will you in the Islamic bank, you can never go for a loan from Islamic bank and they will be charging you interest on it. They base it based on what their religion actually tells them, because they actually feel that the person who is coming for loan do not have money. So why do you still have to charge him interest? It makes economic sense in their view. Another contest will not be accepted. There was a time where I talked about the Christian form, and students were not happy that I talked about the Christian form of finance as the conventional form of finance, right? But we have the Islamic finance. So, Berlin, why don't we have a Christian finance? But we don't have that big. That is what we call the conventional finance. At that point in time, when we give you a loan, we charge interest, but not in all cases. We can still give them what, and we can still give an individual loan without charging interest, right? But in a normal perspective, when you go for a loan from a bank, they charge you interest, and that does not conform to Islamic finance. But when you go for a loan from Islamic bank, that one will be based on the principles of the Sharia law, which says that interest or riba is forbidden. Islamic finance, so I'm reading, Islamic finance has the same purpose as other forms of business finance, except that it operates in accordance with the principles of the Islamic law, the Sharia law. The basic principles include 1. So the Sharia law has this perspective. That is their belief, right? 1. So the belief is that sharing of profits and losses are to be done equally. Sorry for not adding that, right? Sharing of profits and losses, right? Sharing of profits and losses are to be done equally. No cheats, right? No interest into bracket riba, right? This is where we bring that point. No interest into bracket riba is allowed. We don't allow you to charge that, never. Next, finance is restricted to Islamically accepted transactions. What are we trying to say? We all the time prohibit activities which are not ethical in the eyes of the Islamic law. So investment in alcohol, gambling, prostitution, and those bits are not accepted. Monies generated from unethical activities are not considered by the Islamic law. Therefore, ethical and moral investing is encouraged. Therefore, ethical and moral investments are encouraged. Sources of Islamic finance. We have 5 main sources of Islamic finance. So the names are all the time scary to students, honestly. I tell you, it is scary to students. The first one is Murabaha. Murabaha. The Murabaha acts just like trade credits, right? Murabaha acts just like trade credits, just like trade credit. The normal trade credits we know, right? You go get something for free. But well, here what we are looking at is that there's going to be a little reduction. So Murabaha is a form of trade credit or loan. The key distinction between Murabaha and a loan, right, is that with a Murabaha, the bank will take actual constructive or physical ownership of the asset. The asset is then sold onto the borrower or the buyer for a profit, but they are allowed to pay the bank over a set number of installments. The period of repayment could be extended. Oh, beautiful. We are even extending that. But no penalties. Very important bit. That is where it makes it religious, right? Very good to help your neighbor, right? You help your neighbor just like yourself, right? Over here is good for you to do that. The period of the repayment could be extended. So they give you a trade credit, right? You are not paying that. Then they even extend that for you. That although I actually stated that bring my money 2 months time, but bring it 3 years time. And the 3 years extension does not come with what? Penalties or any additional markup to be charged by the bank. Early payment discounts are not welcomed and will not form part of the contract, although the financier may choose not contract to give discount. Which contract to give discount? That is basically. So over here, just like a normal trade credit, in short, we are trying to say that you are owing me. I am going to what? Give you more time, flexibility for you to pay. And doesn't come with any penalties or any charge by what? The bank, which is the intermediary. We go to the next one, Ijara. Ijara acts just like what? Lease. Ijara acts just like what? Leases. Ijara acts just like what? Leases. So Ijara is the equivalent of lease finance. So I think we are going through leases, and guys, I would want you to read on that, right? I want you to read on that. The next item is a beautiful one, which is all the time my favorite, Sukuk, debt finance. Sukuk, debt finance. Within other forms of business finance, a company can issue tradable financial instruments to borrow money. Key feature of these debt instruments are they don't give voting rights in the company. It is only equity shares which creates voting right. It does not give right to profit before distribution of the profit to the shareholders. And they may include securities and guarantees over assets, which include interest-based elements. This does not make sense. The students who read this will not understand that. So here we explain. This just acts just like work and pay, right? It works like work and pay. Those of you who knows more bit about work and pay, right? We give you loan for you to use the loan to buy an asset. And that asset, the loan is the debt, which is called the sukuk. We give you for you to buy an asset. Let's say you came to me, you want to actually do work and pay, all right? That sort of, okay, let me give you loan for you to go and buy that asset. If you buy the asset, you use the car. I am going to make you pay some few cash to me. And that is based on the profit that you will get. And that profit is going to be shared between us equally. So in effect, I bought car for you. And instead of you paying me, just like somebody says sales, making that sales, the sales are still going to be shared between us. In a normal sense, you're trying to say that the person who is poor, you are helping the person who is poor. It doesn't act like the normal perspective of modern days work and pay. No lie, it doesn't happen. If the time for the sales will even not be due, and I start calling you, WhatsApping you, disturbing you. All of the above prohibited under Islamic law. Instead, Islamic bonds or sukuk are linked to an underlying asset. So it can be let's say a car. It's linked to underlying asset, such that the sukuk holder is a partial owner in the underlying asset, and profit is linked to the performance of the underlying asset. So how the asset will move, that is how the profit will be generated. If we're not going to work today, it's Wednesday, right? So for example, a sukuk holder will participate in the ownership of the company issuing the sukuk and has a right to profit. right? So based on the terms, mostly what happened is that in the Islamic law perspective, they share it what equally. But it was just in 2018 where some Islamic banks actually realized that they were really running at losses. So they just actually came out with a discussion so that at least there's going to be either 60% or 40%. But in normal sense, the main objective is to share it equally, right? That is the benefit, not the value on the shares, right? And that's what we are talking about. The next item, that's the fourth, mudaraba. Mudaraba. It acts just like a normal equity. It acts just like a normal equity. So for bombarding you with the Islamic terminologies, right? The last item, which is also acting just like venture capital, is what we call musharaka. Musharaka, right? Good. So, ladies and gentlemen, there's still more information over here for you to read to keep yourself satisfied. Let's move on to the benefits of Islamic finance. Benefits of it has been examined by the CA 3 times. You have to be very careful with that, right? Benefits of Islamic finance. So you can read that one. It helps by assisting financial inclusion, reduce the impact of harmful products and practices, improves financial justice, encourage stability in investment, accelerates economic development, improves transparency. Here it appears the spellings are not in good shape, right? It appears that the spellings here are not in good shape, right? Improves, right? Improves, right? Improves. That's okay. Let me spell them properly. Improves here too. Can do that. Improves, right? Investments, wrongly spelled. Right, that's okay. I think I'm in good shape. So we proceed. So accelerates economic development, improves transparency in investment, discourages speculation. Limitations of Islamic finance, like disadvantages or drawbacks, right? The same item. Let me just indicate that name so that a student will not find himself wanting. So over here, the limitations, we are also saying that disadvantages, disadvantages. Let me just say drawbacks, right? That's sort of right. Sharia interpretation. So these are limitations or drawbacks of the Islamic finance, right? Sharia interpretation, you look at the first item, Sharia interpretation of innovative financial product is not agreed upon. We don't talk about that, right? We don't look at innovation. It's a problem. Documentation is often tailor-made for the transaction, increasing transaction costs. We actually tune it to a particular transaction, it's tailor-made. Islamic finance institutions have extra compliance, increasing issue or transaction cost. Islamic banks cannot minimize the risks as hedging is prohibited. Some Islamic products may not be compatible with international financial regulation. Trading in sukuk product has been limited, especially since the financial crisis, which happened in 2009, right? With no interest, it is hard to claim some Islamic financial instrument as debt, therefore losing the financial tax benefit and increasing the WACC, and increasing the WACC, and increasing the WACC, right? Good. We look at that principle later on. It can be difficult to balance the interests of the financial institution with those of other stakeholders. So this is where we bring our meeting for today, ladies and gentlemen, to an end. In our next meeting, we are going to go through that, but please and please again, still a lot of important bits in here for you to read, and they are all important at the theoretical stage of our meeting for financial management. But thereafter, we're going to look at calculations, right? Efficient market hypothesis over here, very beautiful. A lot of individuals who tend to invest into Bitcoin, this is the issue which is actually telling us why there was a massive fall. Efficient market hypothesis. Cristiano Ronaldo, my very good gentleman, actually pushed 2 bottles of Coca-Cola and $4 million US was lost. That is really sad. Efficient market hypothesis. I am going to give opportunity just 1 minute for question or questions, but still remember that it's still your tutor Henry Berman, And you can WhatsApp me via 0243 583352 or email me via bremanhenry1@gmail.com. 1 minute for question or questions. So at this point in time, you can decide to unmute your speaker and ask your question. At this point in time, you can decide to unmute your speaker and ask your question. If there is no question, then I'm really privileged. But please do not make teaching very simple and easy. You have to troop and bounce, just ask him all questions and let him see that this is teaching. Right? That's it. I like questions. So please and please again, do not run away from questions, right? The question you want to ask, previous meetings, some student has already, or they have already asked that question, please. So do not actually say that you're not going to ask a question. Your tutor teaching you is having a certification in CFA, Chartered Financial Analyst. So you can really see that he's really having control when it comes to financial management. So why do you have to worry yourself in terms of what? Asking question. You have to just come in with your question. Make him what? Answer your doubts. That is it. And that is the main reason why we are in class, right? I do not want you to go without getting an understanding to a bit. Give it some 30 seconds. If there's no question coming up, then I'll bring the meeting for today to an end. Ladies and gentlemen, I think that there's no question because I've not heard anybody talking at this point.
Okay, sir.
Yes, please.
I think where I didn't really get it was the sale and lease back. I don't know if
Sale and lease back. Let me go back to that point. Sale and lease back. Sale and lease back. Sale and lease back. Right. I'm over
So
there.
with the sale and lease back, is there anything like irredeemable and redeemable?
No, we don't have anything like that.
Okay.
The person is just selling. So if you sell it, you get the money. So we do not have anything like redeemable. The word redeemable, probably let me explain. The word redeemable means that the principal is going to be paid on a later date.
Okay.
And irredeemable means that it will never be paid throughout.
Okay.
So when you sold the asset, they gave you money. So you cannot just say that we do not have that on the planet. That we have types of sale and lease back as redeemable and redeemable. Never. We have it just sale and lease back. The person who is the owner of the property will just sell it to another person, get money for selling. And after getting his money, he has sold his property. He's no more the owner of that property. He will now go back to the person he sold to and lease it from that person. Some dubious accountants tend to look at that because it's having impact on the financial statement preparation. So if they want to come back to creative accounting or earnings management, they tend to go by sale and lease back. But that is the explanation. Raphael, I think the question is coming from Raphael.
Yes, and so I also want to know if a listed company or a quoted company can also engage in a dark pool trading system.
Right. They can also engage in a dark pool trading system. They rather have a wider coverage when it comes to looking for where to get their funds. Right. They can go by that. Right. In the case of Ghana, in its entire sense, we have even practiced a dark pool trading system where we Nicodemously talk to people who can issue a particular bond. Then we actually went into it. So that's not necessarily, we only go to the open market, right? To actually let people know that we're giving everybody the chance, equal chance of being probably a shareholder. But that's not necessarily mean that we're only restricted to that. The quoted company rather have the two. Can either go by the dark pool trading system, which is just contacting some private individual who are very rich, mostly to get your funds, or by just doing it in an open, that is in the stock market. But in the case of the quoted, they do not have any other perspective of just getting that, with the exception of what? Just going by the dark pool trading system.
Okay.
Please, from testability perspective, it is important for you to really get a good grasp of these theories. Raphael, it appears you are not done. Thank you for the questions. I really like questions. Please, let's continue. Right.
I want to know, if with the dark pool system, there are still brokers involved.
The dark pool trading system, it depends on the situation at hand, but the broker only acts when we are talking about the stock markets. But
Okay.
you can still get some people who still charge you some transaction fee because you never knew any rich person and they are serving as a middleman to actually link you up to that person. So they can charge you some fees, which will be a transaction cost. But that is not the normal work of the broker. That is not
Okay.
the broker do not act in that jurisdiction, but he can still charge you some transaction cost or some transaction fee for having identified the rich person for you because you couldn't do that and linking you to that individual, right? If a problem emanates, you are still going to hold him accountable. If it tends to link you to somebody who is a fraudster, problem what tends to arise. So there's still going to be some transaction cost, but that individual can still be a broker, but he will not be a broker in that context of the dark pool system.
Okay.
But he will still charge you a transaction fee for having gone through the process of linking you. That's all.
Okay. But so with the dark pool system, is it legal or it's illegal considering the
It
name?
is accepted. It is
Oh,
accepted. It is legally what? Accepted. Not every, if you are not going to make it what? Legal, then in fact, make things cheap. Before you be accepted on the stock market, there's supposed to be compliance to procedures before you will be accepted. And it's not easy. And just like the case of what? Startups. A startup business is not having the spines to go to the stock market. So are we going to say that they cannot contact some individuals? It can be families, can be family members. You can contact them for money. And it's not the dark pool trading system. So it is legal.
okay. And so
That's okay.
with the IPOs, the
Initial
initial
public offering. First time what? Or offering. Yes.
yes. If a foreign company is operating in Ghana, I learned there is a percentage of the shares that should be for the citizens before they issue the IPOs. I want to be clear on that. If
You are
only
right. You are right. Some jurisdictions, just like in the case of UK, it's hard for you to go to the UK and own a property or an asset, right? No wonder the boss of Chelsea, Roman Abramovich, is still renting the Stamford Bridge. He want to find all means possible to buy that, but he said, never, we will not give it to you. You have to be paying for rentals. So there are instances where we do that to protect our own businesses. So it's true. Some contests, businesses in particular countries would like its members or its citizens, its locals to be the majority shareholders. They do not want the foreign nationals to actually have control because we said that the number of shares that you have will tantamount to control in taking decisions and other bit. So it turns out to be practice of some companies. Yeah. But some companies which are not having good corporate governance principles tends to allow a lot of things to affect them. They do not look at all this way. They allow themselves later on. We have a lot of foreign nationals in Ghana who are owning properties, and they tend to even evict Ghanaian nationals from their rooms to the point that the Ghanaian nationals do not even have a place to stay. So that sort of condition tends to exist based on whatever happened, tends to protect the individuals. If it is having a leeway, it affects the individuals who are
okay.
citizens.
Is there a fixed percentage of the share of that foreign company before they issue the IPOs?
Sometimes the legislation of the land can recommend that probably, let's say, less than 10% is supposed to be given to foreign nationals, but it varies based on countries. And we
Okay.
can also say that we are not even going to go by that situation of even giving a portion to the foreign nationals. Just like the case of Indian companies and Lebanese companies who are all, a lot in Ghana and they are owning pharmaceutical companies in Ghana. They do not allow the Ghanaian base to actually get closer to a lot of sensitive information. You can find out from those bits and pieces. So the regulation or the legislation of the land can actually decide on that. right? The legislature of the land can actually decide on that. If it's just a robust one, it will actually give them maybe just 5% or 2%, because we need not to give them so much for them to actually get control. No, never. We need not to do that.
Okay. All right. So thank
Right,
you.
that's okay. Raphael, thanks for the questions. I really appreciate that. Thank you very much, guys. I think that there's no question coming up. Please, I like questions, so it's good for you to ask questions. The main objective is to understand. The main objective is to understand. So, an understanding, one way of understanding bit is asking questions. I like questions, right? I like it.
Mhm.
Thank you very much for the time. Have a very good evening and see you in our next meeting. Bye bye.
Yeah.